Step number 2 in our process is to review. Now, the first thing that I would do, and I'm actually going to bring the 2 points together here, is a high-level analysis, including comparing to prior years. So in step 1, we obtained our financial statements from our accounting software. And again, using our intuition, using our knowledge of our operations, take a look at those numbers. Are they aligned to your expectation? Let's say arbitrarily, you held a gala this year, and you know, because of, I don't know, maybe the pandemic or whatever, that last year the gala wasn't as successful as this year. So if you look at your financials in your accounting software, and it's actually telling you that this year's gala was worse than last year's, then you know from your intuition that doesn't make sense. Something's not right here, and it needs a little bit of investigation. Again, comparing to prior years will allow you to determine if any significant fluctuations make sense. So comparing to the previous year, you might see a significant increase in payroll expenses. But actually that might make sense because you've brought in 5 new employees this year because of a new grant that you received or a new project that you're developing. Now, again, it's important to note here that auditors will always ask for significant fluctuations and able to quantify that. That's going to be their step 1 in their risk assessment. So by looking at this data, financial data year to year, you're kind of getting ahead of the game there. Again, review your key financial documentation. So again, we said in step 1, let's obtain all that documentation that you know of the significant things that have happened during the year. But then if we need to review that documentation to make sure that we've recorded things accurately. Let's say, for example, that somebody pledged to you $100,000 in the year, and they're going to give that to you in 2 $50,000 checks. Well, it's important to note here that you can record that $100,000 there and then. We don't have to wait for the cash to come in to record it. So you might have only recorded the 1 check that you received. So again, by just comparing this key financial documentation to what you have in your financial data will be a huge step in making sure that your data is fundamentally accurate. And prior auditor correspondence. So again, I know some of you are new to this and maybe haven't gone through an audit before, but every single year your auditor will give you what's known as a management letter, as well as any adjustments that they've had to post into your books and records. And I would suggest that this is very, very key here, because reviewing this correspondence allows you to know not only what the auditors might have found in the previous year, but also any adjustments that they posted. And if they had to make adjustments, an adjustment, for those who may not be aware, is where the auditors reviewed your financial information and determined that something was incorrect and they've had to adjust for it. By reviewing that, you get some insight into where the auditors found these potential errors or potential areas for improvement, and you can kind of get ahead of that this year, maybe scrutinize that data a little bit more, because ultimately the end game is to have no auditor findings and no adjustments. And again, the audit management letter won't necessarily just include numbers. It might include recommendations for your processes. For example, again, a very silly, arbitrary example, the auditors might ask you about your cash, and you might have a petty cash box full of bills used for events and programs, whatever. And if the auditor finds out that that's kept unlocked in the staff communal area, they're going to make a recommendation there. Let's lock that. Let's put it in the finance room with limited access. So audit management letters will always include very good recommendations for your organization on how you can make things more efficient and safeguard your assets. A couple of top tips that I have for you. Don't sweat the small stuff. So again, I mentioned comparing financial data year on year and looking for these fluctuations. I'm talking about significant fluctuations, okay? I don't want you to be dedicating time to see why your office expenses has gone up by $100 on the prior year. Auditors won't be too concerned about that, okay? So in auditing, there's something called materiality. And what that broadly means is if your financial statements were incorrect by X amount, that would influence your opinion and your understanding of those financial statements, okay? Now, again, auditors will never tell you what that number is, because obviously that's inside information for them. That's the reason that they're auditing. But equally, it's important to you to determine how what the auditors will be looking for in terms of significant numbers. So I would suggest, you know what's big to your organization. Let's not sweat over small increases, but if your accounts receivable or your grants receivable has increased by $100,000, let's look into why. And board reporting packages. So again, what we're doing through the audit process is we're looking at a year's worth of financial transactions, a year's worth of data, okay? And when we come to the audit process, of course, we're going to be looking over that full year of data. But I would recommend implementing, if you've not already done, maybe a quarterly or a semi-annual formalized board report package for internal use. What that allows you to do is it allows you to break up your deep diving in your financial data into, if you're doing it quarterly, 4 times a year, which makes things so much more palatable when it comes to getting to the year-end process. If you've already looked through your financial data in stages throughout the year, it's so much easier than going through one whole year's worth of data than it is if you do it throughout the year. Because bear in mind, an auditor might recommend or propose an adjustment to your numbers, okay? And even if you have like brief board packages now where you just run the financials and send it to the board, or you run the financials and they're the results without any investigation, an auditor adjustment as part of the annual audit might have been related to the first week of January if you're in a calendar year, which means that all of that information that you provided throughout the year was incorrect from the first week. So I do recommend a thorough board report package, full review process throughout the year to make the year-end audit a lot easier.